AMAT is one of the larger semiconductor companies in the entire world. It boasts a market cap just under $140 billion. And over the last 5 years, it's up 180%. Maybe you're too used to looking at NVIDIA's chart, and that doesn't sound crazy to you, but that is doubling the market's performance over the last 5 years. The S&P 500 is only up about 90-ish% over this time frame. And if we zoom out, when the S&P 500 has only gone up 200%, this stock has climbed from 25 all the way up to 170. It's not just that. This is a company that has hit all-time highs in the 250s. So even if it were to just recover to all-time highs, this is a company you would have done decently well on. Now, of course, it depends on when it does that. But this is a company that is well positioned for the future, I believe so. And we're going to talk about not just AMAT's performance prior, but what it can do in the future. We're going to be diving into its growth potential, and maybe you don't even know what a semiconductor is. We're going to be talking about that, going into the background of the company, and just covering hopefully most of the things you would need to know before investing in this company. Of course, when investing in a company, it's important to actually understand what they do. AMAT, it's not the simplest, but it's not crazy hard to understand either. Basically, the company's broken down into 3 different segments. The first 2 are the only ones that bring in any meaningful revenue at this stage, so we're going to kind of ignore the third one. So you just got semiconductor systems and applied global services. So semiconductor systems is just what they sell. That's the bulk of what they do. Of the $27 billion they did last year in revenue, $20 billion of that basically is from the semiconductor systems. And that's just semiconductor systems that help the fabrication process, the fab process of the advanced semiconductors. Advanced and non-advanced, but generally the advanced one is which requires more machines, higher tech machines. So basically, if you're understanding the entire process down to like an NVIDIA AI GPU, basically NVIDIA buys product from something like a TSM or a Samsung. Generally, TSM has most of the advanced portion, the advanced segment of that. So TSM makes that stuff that NVIDIA uses, but TSM buys from products from companies as well. They buy from ASML, they buy metrology systems. They buy lithography systems. I would be lying to you if I said I know exactly what those do. Almost no one does. They're crazy complicated. They buy materials from AMAT, right? These semiconductor semiconductor systems. They have to buy from. And there's some other companies that come in as well. KLAC is one, Lam Research is another one, but that is the bulk of what you get from AMAT, and they do semiconductor systems and advanced semiconductor systems with that. And then the applied global services. So you can read this a little bit for the first one, but reading a little bit into the applied global services segment, integrated solutions to optimize equipment and fab performance. Mainly this is what I'm interested in, right? Software for semiconductors. That is important. If they're selling some software to go along with it, generally software is pretty good, right? You get a recurring. I mean, if you look at the profit margins on many of those businesses that do software, they're much higher because you just kind of develop it and then people pay a subscription service and then you're good. And one thing with AMAT, although it's a good company, right, we're going to talk about how much it's grown. We've talked about how much it's grown. They do not have super high margins. The semiconductor systems require lots and lots and lots and lots of money to go into it. Doesn't mean it's a bad business, but it just requires a lot of capital to be put into it, and you're not going to have crazy high margins. The machines just take too much to make. That's just how it is. So if you can continue to grow the applied global services, that can help grow your business further. But AMAT, basically just understand that they make semiconductor systems that are very important into making all the advanced chips in the world. Companies like TSM, Samsung, Intel in the future, if they get that going, require systems. They don't require systems from them, but the companies they buy their stuff from require systems from AMAT. So they're a crucial component in the semiconductor making process. And semiconductors clearly are just computers. Basically, that's the basic now. There's varying degrees of that, but AMAT is a important key or an important cog in the machine of this process. Taking a look at AMAT's PE, we can see here the PE is 20, while the forward PE is 18, just over 18. The S&P 500 is about 30 and then 23. So this is a company that is significantly below the S&P 500 PE, but it gets a little bit better than that when we factor in, okay, how about its performance? Well, the S&P 500 is up about 80% over the last 5 years, up about 200% since 2015 or so. A little bit more when you factor in dividends, but this one pays a little bit less of a dividend. But still, you're clearly outperforming. You're up from 25 to 170. Very good performance last 5 years. You were up 177. If you just bought 5 years ago, 10 years ago, forgot about it, woke up in a coma, you would be happy with that performance. You would. This probably would not be the worst stock you owned if you owned a lot of single stocks over that time frame. It would be pretty unlikely. They have performed well. Then you may ask yourself, why is the PE lower? Well, there is recency bias, and recent performances do factor in. And when we look at the recent performances, specifically from 22 to 23 and 23 to 24, not super impressive. Now, 2021 was good. 2020 was good. 2019 was pretty good as well. These last couple years were not super impressive and not what you would want in a company to do. Now, technically, if you have great years matched by worse years, doesn't really matter in the long term. However, it still factors into the price today. That's what we're looking at, 4.5% growth, 7.5% growth. That's not what you would want long term in a company. This is earnings per share specifically. Not super impressive. One thing we're looking at, GAAP, nothing really there, so not going to worry about it. But it's really not that great. You would want 10 to 11 to 12% year over year, because that's roughly what the market will do, the average company will do. So if you're underperforming that in the long term, you will underperform the market. 2.8, or 2.5. Revenue is even worse. But like I said, if we look at the last 4 years, just washed out, let's just look forward. What is this company doing? Okay, this next year, they're projecting 8.5 in earnings per share, 7.8 in revenue. Three things, that is a little bit low, right? We're aiming somewhere from 10 to 12, ideally more, because if we're going to invest in single stocks, we would want it to outperform the market, or else why wouldn't we just buy the S&P 500? So, but either way, let's try and get it to that 10%. So 3 factors when we're looking at this I want to factor in for the positive side of it. 1, they just had 2 poorish years. You would expect them to, okay, maybe it takes a couple years to ramp up, and this isn't the worst year, right? 8% isn't the worst year. It's not negative. It's not 2% even, somewhere in the 8%. That's 1. 2, they beat all this last year, every quarter. Beat. So if we're not being conservative, we're being a little optimistic, or somewhere in the middle, we can say, okay, maybe this will be a bit higher. Maybe instead of 8.5, it'll be 10. Maybe instead of 7.8, it'll be 8 or 9 or 10 for revenue. That's really not bad. That's kind of where we want to be, maybe a little bit low, but that's somewhere in the realm of where we want to be. 3, there is a lot of semiconductor stocks not doing too hot. The market generally isn't doing good. I know Micron just had a good quarter as of recording of this. However, you can see it in something like STM, right? And I know they're a lot more niche and they're smaller, but still, there are not a lot of semiconductor stocks just on heaters. Some are. Obviously, NVIDIA is, Broadcom's doing pretty well, but they do a lot of really direct stuff to AI. That is just booming. AMAT is in the space, but a little bit more indirect through TSM, and a lot of companies that AMAT supplies to probably aren't doing incredible. So when I look at this, yes, there's a reason for their PE being cheap. However, if we look at the history of the company performance over the last 5 to 10 years, leadership has been able to beat the market and beat it pretty substantially. And hey, it's not the worst bet in the world to make to invest in a company that is in a good space, that is cheap, and has a track record of performing well. And that's kind of what we're looking at with AMAT right now. Taking a look at the balance sheet, the first thing I always like to do is look at debt, because it tells you a lot about where the company is. For them, their debt is pretty high, not crazy high, but we see $5.4 billion in 2020. It actually made up more than the income they brought in, so that's pretty high. However, we're sitting at 7.8 now, then 6.2. So yeah, debt is under the income we bring in for the year, but it's still pretty high. However, in this business, really not too surprising, nothing crazy dramatic. Not every company can be like the Mag 7. I just did a couple videos on them. I did Microsoft and Meta. Their debt is substantially lower, and many times they don't even really need debt because they have super high profit margins, things like that, super high growth in income, growth in revenue, just everything. And those companies are a bit of an anomaly, and they have so much money and so much capital and just everything at their disposal that you see crazy high income compared to debt, profit compared to debt. You don't really see that with this company. However, it's still not crazy. It's not terrible. It's not horrible. It doesn't mean it's going to die or anything like that. We can see an increase in total current assets, total assets. We do see an increase in liabilities, nothing that you wouldn't expect. So there's nothing here that's really screaming, oh, this is crazy bad. It looks pretty normal for a company growing at this rate. One thing that is interesting, though, is they are, even though, so one, they do not have a high profit margin. We can see on 27 billion in revenue, we had 19.3 in operating expense. We're going to dive into that bit in the future of this video. We're going to kind of break down where that all goes, but specifically, they had a 4.4 to 7.8 increase in profitability. So they almost doubled, not quite. We can actually see here these numbers, right? Revenue increased roughly 58%. Profit increased roughly 1.82%. So almost doubled over the last 5 years. That's good. That's a good performance. But clearly you guys can do math and you can tell 0.58, 1.58, 1.82 are not the same. So they increased profitability more than they increased revenue, substantially more. So this is a company that is increasing its profit margin. We can see that over the last couple of years as well. We already looked at that. It was 2.5% in revenue, 2.5% increase in revenue, and then we had like a 5 and then a 7% or something off the top of my head. We're seeing an increase in earnings per share, an increase in margin, and we're seeing that over the long term. We're seeing that year after year after year, showing us that the company is becoming more efficient, or they're transitioning to products that have a little bit of higher profit margin. They're emphasizing them more. That is common. Both of those are common for companies. I don't know exactly for this one. I don't have quite the time to go that in depth, certainly not in this video. But either way, you're increasing your profit margin, you're increasing it fairly substantially. That is important, and that is actually pretty impressive. It really is to increase it by this much of a gap. So over the long term, this is good. You would hope to see this continue to happen, or you would like to see revenue to ramp up more dramatically, and it seems like the revenue maybe isn't as possible, or at least it hasn't been as easy to do. But this is a company that's still done well. I say that a lot, but like I said, when you've performed how well you have, it is a good performance. And actually, you've seen it almost, right? If we're talking about an 1.82% increase, nearly doubling, you've done a bit better than that on your performance over the last 5 years as well. So that's something to think about, and we're going to dive next into some of the revenue. This is a pretty good visual representation for AMAT's last full year in business, just under 27.2 billion, and then of that, just under 20 billion of that is from the semiconductor systems. And then we get some of that from the applied global services. It's 6.2 billion. It's a growing part of the revenue, and that's going to be generally higher margins, right? That's the software accompanying, the fabrication stuff, the other systems they use with it. But that's generally not a large portion of our revenue at all, right? Not right now. It's 10%, 20%. It's closer to 20%. So that's not huge. It's not nothing. And if it continues to grow, that can really impact your margins substantially, right? If this were to double, well, hopefully you're increasing this as well. But if we were to double, we will see margins increase substantially. And looking at margins, cost of sales, 14.28 billion. That is a lot. That is a lot. Certainly if you're looking at other companies, not in this sort of sphere. If you're looking at, I don't know, like a Walmart, probably not that much. But compared to a lot of other similar tech companies, certainly like an NVIDIA, but like an Apple, a Google, even something like an AMD definitely does not have cost of sales as high. But that's just this specific business. It's high. It's going to be high. It's never going to go down as long as semiconductor systems maintains being a large portion of your sales. But it's not, doesn't mean it's a bad business. It just means that, okay, this is something we're dealing with. And if we can see, like we have seen, their margins continue to rise over time, if we can continue to see that, there's only so much you can cut here, and you'll have to cut into here, or this will have to grow. The global services will have to grow over time as well. But as long as revenue grows, you don't matter. But if you can grow on top of the earnings on side of that, I know I've talked about margins a lot, but with this specific business, it does seem pretty key at this point. But even from that 27 billion, you're taking about exactly 7 points. So just take off the 20 billion, and then you're taking exactly 7.18 billion in profit. So that's good. That's really not bad. It's not, certainly with the amount of debts you have, this isn't a company that's in any risk. They seem to be taking home a decent profit from it. But over time, like I said, this is what I'm looking at. Either grow earnings, grow revenue, or grow margins. Have this be a larger segment is how you're going to, over time, continue to grow this fast. Taking a look at historical PE is important to understand, okay, am I buying this company more expensive than it historically is, cheaper than it historically is? And that doesn't always mean that you're getting a bad deal or a great deal, because companies change over time. They have higher PE ratios if they're growing way faster. because people are willing to pay a premium on it, and that just might be how it trades. However, with AMAT, this one is actually pretty simple. Their PE ratio since 2014, middle 2014, of course, there's maybe spikes, maybe downswing, but basically they're somewhere between 22.5 and 11. Historically, they've been that. You can see a peak at 26. You're right, 17, 18, 14, 18, 18, so 17, 14, 11, 14, 19, 18, 23, 21. Now where we're sitting at, which is right about 19, 18-ish. So you're right where you historically have traded. They've always traded in this range. So, well, that's telling me two things. One, if we look back in a decade ago, they were making 1 earnings per share. They are now currently making 8.5 earnings per share. That is very, 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 very good growth. So this shows you, oh, okay, this is a company that, although the share performance has done incredibly, it's not because of an inflated PE. Don't get me wrong, there's companies that have done better. Like at TSM, I love TSM, but their PE ratio over the last decade, part of their stock performance is because it went from somewhere like 10, 11, 12 PE to where it is now at 30. So a lot of that growth has come from the PE ratio inflating and not necessarily just purely growth. AMAT has just pure growth. They just do, and they've just traded in this PE range ratio. So 2 things to note there. That is great growth. And then 2, you're buying in the middle of the historical range, not at the top, not at the bottom, right in the middle. So this tells you this is probably a fair valued stock. It's actually, I would consider a little undervalued because for 2 reasons. It's in a very important segment, and 2, they've grown way better than the average company. Way better than the average company. So I think if they were to do this for another 3 to 4 to 5 years, grow at this rate that they have been growing, which I don't expect. But if they were to even grow, I don't know, 150% whenever the S&P 500 goes up 100%, somewhere in that range, I would expect this company to inflate PE more and probably stick somewhere in the high 20s. The average company I look at that does this type of performance, somewhere in the high 20s. And we are not that. We're in the low 19s. I know the earnings per share growth hasn't been there the last couple of years, but historically it has been so. That's what I'm seeing with the stock. You can draw different conclusions, but that's what I'm seeing with my own eyes. Every company has unique risks and advantages, and it's important to talk about them here now. Of course, I can't cover every single risk specifically. So if you have any unique ones I didn't cover in this video or specific ones I just didn't cover you think are big, feel free to ask me in the comment section. I'd love to address them with what I know. But with AMAT specifically, the first one that just comes to mind is the cyclical nature of semiconductors. Now, what does that mean? That means there's going to be cycles of boom and bust generally in it. Now, you can see that most clearly in a company like Micron. Look up something like Micron historical. I do historical PE and go to macro trends. That's what I do in this video I did earlier. You get that historical PE alongside the earnings per share. And you can see it's clear. It's up and it's down for like 2 to 3 years. It's up. 2 to 3 years it's down. 2 to 3 years it's up. And it's a growing company. It's growing fast, right? If you buy during those downturns and you hold it for 10 years, if you bought in like 2013, you would have done phenomenal for the last 12 years. But that does mean there are periods of time where the company just isn't doing phenomenal. People just aren't pouring money in. It's just how it works. And with AMAT, it's not going to be the worst for that, but understanding how the business works, how the general landscape of this works is important. And that is something that not everyone likes because, hey, stock being down for 2 or 3 years necessarily isn't always fun, but you can time that. You can actually use it to your advantage. You can buy when it's low, hold when it's high, or sell when it's high if you want to. I like holding successful stocks, and I believe AMAT is a successful stock if you haven't picked that up from the rest of this video, but I do like this stock. Another risk, I mentioned it throughout this video, but it's just the profit margins, right? You're going to have to pour money into this business, and that also caps your ceiling. When you imagine like the perfect scenario for a company you hold, like if you buy an AMD, right? I love AMD. It's another stock I like. I don't think it's ever going to do what NVIDIA did. However, it has the chance to. They do the same thing. If they hit it out of the park, they do phenomenal. They can grow immensely. They could 10x in 5 years if everything went perfect. AMAT, unless they were like absolutely in the gutter bankrupt, they're not going to 10x in 5 years. It's just not really possible. They can in 10. They've almost 10x in 10. Things have gone very well. But you're never going to go up 300% a year. You're never going to have that 2,000 in a decade. It's just not going to happen because of the way the business is constructed, unless they shift way more towards the services side of the semiconductor industry, which I don't really think is possible. I think there's a pretty clear ceiling on that for now as well, although they're going to try to continue to grow that out because it's a higher profit margin. But it's still going to advantages. This is still a company that is crucially important. It's a very important cog in the machine that is the semiconductor industry. Over time, theoretically, they could be replaced. Any company could. However, the short term, let's say 2 to 3 years, it's basically impossible. They're too important. They provide too many machines that are vital to making semiconductors. They just are. So that is a huge advantage. That's a large economic moat that they have. It really is. There's a lot of kind of foreign companies in this. This is an American company, so there you go. But it's just a company that's done well. And like I said, that moat isn't something to disregard. Another quick side note, Schwab rates this high. I don't spend too much time on analysts in my videos. Personally, I think analysts, not that they're completely useless, but they kind of just say and take the safe side of things, right? They don't say anything crazy. They have kind of their own interest as well, generally. But Schwab does think they're going to do good. They give it a top 7 percentile rating. That's, believe it or not, one of the better ones. An A. They said that 2 days ago or 3 days ago. So I think this is a short-term outlook, and this is what they give it. So that's basically all I have for the risks and advantages segment. I'm not the biggest stock price projection guy on this channel, and that's for a reason. And that's because I think there's too many variables in the short term, and I'm not talking short term like 3 months. I'm talking short term like 1 to 2 years. Too many variables that can happen that can throw off the price of a stock, even if the company is doing good. And that's not the point of this video. This point of the video is to break down the company and the stock together. So I think over the long term, let's say 5 to 10 years, because who knows, if a recession occurs 5 years from now, it's not going to look good 5 years from now, even if the stock has done well. I think over the long term, this will be a company that has a very good chance at outperforming the S&P 500. One reason is because it already has. 2 is because it's just set up in a very good industry. This is a good company. They've grown revenue and earnings per share dramatically over the last decade. They've done it over the last 5 years. They will probably continue in the future to do that. It has a great moat. It's a very important company in a very important industry, and it's had leadership that has done well. That is the most important thing you can have in a company, and it's not crazy expensive. Another plus as well. Now, like I said, some companies have a higher ceiling. The biggest downside with AMAT, in my opinion, you're never going to have that just incredible, it's like almost like a lottery ticket. When you buy a stock, you hope it does well. Oftentimes they do. You're always kind of praying, hey, maybe I get the next NVIDIA. I don't think it's possible to get that with AMAT. I think you can get a company that performs very well and you're very happy with it. But it's probably never going to be that lottery ticket, wow, 3,000% in 10 years. I just don't think so. However, I think this company will continue to outperform the S&P 500 over the long term. I think every time the S&P 500 goes up 100%, you would expect AMAT to go up 125 to 150%. And I think you would probably be pretty happy with that. So that's what I think. But of course, I cannot predict the future. However, I do personally have some money in AMAT. So if I'm wrong, I'm going to pay for it a little bit. But anyways, I appreciate all of you for watching the video. If you made it this far, I know you at least enjoyed it a little bit. I'd appreciate mostly if you subscribed and checked out some other content I do on this channel. I do daily stock content, and I appreciate all of you for watching anyways. I'm just here to have fun and educate and hopefully create a discussion about stocks in the future. But if you enjoyed, like I said, appreciate if you like and subscribe, but I just appreciate all of you for watching, and I'll catch you next time.